Okay, so maybe as we get started, I'm just going to welcome everyone and call the meeting to order. We are recording, and this will be posted on the IBO website later. I'm just going to kind of do a roll call of people that I've seen, and if I've missed you, you can then announce yourself. So I'm Jennifer March. We have Wayne Ho, Deborah Golbe, Mark Mazzaro, Mark Page, and Tony Shorus from the board. Ronnie Lowenstein, Lisa Neary, Doug Turetsky, Sarita Subramanian, Sweeting, Tara Swanson, Montserrat Fernandez. These are all IBO employees. Preston Niblock, I saw, and there were a handful of other people in attendance, but I don't have your names. There were Katie, Tanya, Alex, and Jonathan, if they could introduce themselves.
Okay, Alec, I'll introduce in a moment. Jonathan Rosenberg is head of budget for us. He's just been joined by Fenwick Huss.
Morning. This is Richard Lee from the Queens Borough President's Office. I'm also here.
Oh, good. Thank you.
Let's start with approval of the minutes of the October 2nd, 2019 meeting, which is incredible. It's over a year ago. I need a motion to approve the minutes.
Moved.
Seconded.
All in favor?
Aye.
Super. All right, I'm going to turn it over to Ronnie Lowenstein for the director's report. Ronnie, it's all yours.
Thank you. First thing I'd like to do is to introduce Alec Goodwin. Alec has the distinction of having showed up to start work at IBO, I guess 2 weeks exactly before we shut down. Amazingly, I think he seems to be holding up and adjusting well. And we're really glad to have him. Alec holds a Master of Philosophy from Oxford and got his undergraduate degree from University of Chicago. And he's covering housing, which for IBO has been one of our most important and productive portfolios. So welcome. Okay, I just wanted to say a few things about upcoming publications. As I think many of you know, IBO maintains a running list of options for bringing the city's budget into balance on our website. There are a variety of ways to increase taxes and fees, ways to decrease costs, ways to shift funding to other levels of government. And we periodically refresh it. Given what's going on, we thought this was a good moment for a refresh. So we've got about something shy of 100 options up there now, and within the next few weeks, we'll be putting up roughly 10 new or very substantially revised options that really run the gamut. We were trying to get some larger options, so a number of them, of course, deal with labor issues. One that's sticking in my mind is eliminate health insurance for city retirees who have other jobs for which they're eligible for health insurance under their new employment. Other things that would, other ways that would cut the cost of labor, down to things like increasing fines for multiple red light violations, whether it's going through a traffic light or speed zones in front of schools. If you rack up too many of them, all of a sudden the fines would increase. So that's coming within the next couple of weeks. And we're just a few weeks away, amazingly, from starting our next round of forecasting. George is going to tell you a lot more about the forecast in a minute. But what I wanted to stress here is that even though our focus is very often on most closely on the upcoming fiscal year and the year after, I think we've got really grave concerns about the longer term economic health of the city at this point. It seems likely that the city's recovery, economic recovery, will lag that the nation as a whole. It's hard to see that the entertainment and arts industry is going to be back up running full speed anytime soon. And it's hard to think that the tourist industry, and particularly international tourists, are going to be saying, hey, I feel great about coming there anytime soon. And then looking to the city's business sector, we've all now, for better or worse, gotten mostly used to working remote. And it's not clear what that's going to mean for the city's office sector going forward, and all the repercussions that has for other sorts of businesses. And ultimately, the city's most important tax is property tax. So you're going to be hearing a lot about what's happening in the near term, but just keep firmly in mind that there are long-term issues here that certainly in the 20 plus years IBO has been around, we've never had to confront. Okay, having said that cheerful message, I just wanted to highlight a couple of upcoming publications. We have 2 publications that touch on economic development issues. The first is a look at infrastructure funding that's accompanied the rezonings under the de Blasio administration, looking at how much money was involved, whether there was more money early or late, what those funds are devoted to, how much of it is already in the capital budget, how much of it was for new projects versus legacy projects, and on and on. We're also nearing completion on our second evaluation of an economic incentive. We do that more or less each year in conjunction with the City Council. This year we looked at the IDA, the Industrial Development Agency, which was created in 1995 to promote manufacturing and to move away from the one-off corporate retention deals that I guess characterized the Giuliani administration. Or we could just say the administrations prior to that. We're also going to be putting out a comprehensive look at the criminal justice system. Normally, people look at agencies, and this is more than just adding up the various agencies. We're also going to be looking at programs within agencies that you don't normally think of as having a criminal justice component. We've already done small pieces of that project and released them as by the numbers or brief graphics publications, but we're going to be putting them all together and issuing that. And the last thing I wanted to highlight was we'll be putting out a study on elementary school choice. It looks at the process for applying to attend an elementary school out of your zone or out of your district, and to see whether we're looking to see whether there are any differences by demographics. I mean, different demographics do this more or less? Are the outcomes, their ability to actually do those transfers different? And whether different categories of students, such as English language learners or special ed kids, are they affected differently? So all of that is to come. And if there aren't any questions, are there? Then I'd like to go ahead and introduce George, whom you all know.
Sorry to interrupt, just 1 sec. I just want to there's one phone number on the screen that we haven't identified who called in. It's 6463 and then a bunch of asterisks. Can you identify yourself?
Yes, this is Kevin Roach,
No.
or Carrington and Sutcliffe.
Thank you. We thought it might be you, but just wanted to make sure. Thanks.
Okay. If there are no questions, I'm going to go ahead and introduce George, who's identified as IBO Conference 2, but who you all know, who'll be talking about the city's fiscal outlook.
Good morning, everyone. As Ronnie said, I'll be speaking about the fiscal outlook, and particularly the outlook as the 2021 budget was adopted at the end of June. IBO published an additional round of forecasting this summer. We published as the IBO snapshot on the adopted budget. Mostly I'll be talking about sort of what the conditions were leading up to adoption and then the steps that were necessary to adopt the balanced budget for 2021. And then we'll provide some details on some of the changes that have occurred since the budget was adopted. And some of that new information may change some of the assumptions about the timing and the severity of the downturn in the city's fiscal condition. So the main points I'll be trying to make this morning are, first of all, that the pandemic did lead to enormous economic and fiscal shocks, and it created a real challenge at budget adoption. The city continues to face challenges for the near term, but fiscal year 2021 may not be as bad as originally anticipated. There's been some good news since adoption. And that good news could carry forward, and I stress the word could, into fiscal year 2022, which right now has a very large projected deficit, but it may be manageable if some of the good trends we've seen for 2021 hold up. And then finally, as Ronnie indicated, although in the near term things may be sort of manageable, things definitely look shakier, and the threats to the city's economy and the tax base and the budget look more dire as you get beyond the near term and actually even past the financial plan period. So what was the outlook at adoption? Let's start with what we were observing in the US economy as a whole. This chart shows change in US real GDP, gross domestic product, between 2000 and 2020 is actual, so that's the dark line, and then it becomes a forecast after that. And these are annual changes. So our assumption was that GDP would contract by 5.3% in calendar 2020. And that's more than, you can see the decline here, and that's more than twice the decline that occurred in 2009 during the Great Recession. In limiting that contraction to only 5.3%, that's interesting to call that limiting, we assumed that there would be a fourth stimulus bill, which of course has yet to arrive, that there would be improving public health response to the coronavirus that would rule out a second wave, and also that there would be a vaccine widely available in the first half of calendar year 2021. Given the poor performance in Washington on the first of these two, the actual 2020 decline or contraction may well be larger than the 5.3% that we assumed. We'll have to see. We don't have the third quarter yet. And just quickly, if you look at the bottom left, the table shows a comparison of IBO's and OMB's projection of real GDP in the summer. You can see that they're pretty similar, particularly for 2020. The one exception is 2021, where OMB was projecting a really strong bounce back, and presumably in the second half of the year, to get up to 6.3% decline, 6.3% growth in from 20 to 2021. We have a much smaller anticipated increase there of 3.1%. So OMB was forecasting a very sharp V-shaped recovery in this calendar year. Ours was a bit more of a swoop, with the recovery somewhat attenuated. And if anything, we probably would attenuate the recovery even more, given what we've seen in the months since adoption. There have been slowing employment gains and increasing long-term unemployment. And of course, the COVID case rates have continued to go in the wrong direction. All of that probably indicates that when we do our next forecast, we will have a somewhat larger contraction for 2020, and we may have even a slower rebound in 2021. This next slide, I put it up here just to demonstrate how unprecedented the collapse in New York City employment was this year. What we've got here are the quarterly changes in New York City employment from 1990 back here through the second quarter of 2020. And if you look at just the last two bars, you'll see that's the first quarter of 2020, the city lost 53,000 jobs. And then in the second quarter, it lost another 822,000 jobs. That's nearly 20% of the city's pre-pandemic employment. And it's the largest reduction in a single quarter that's ever been observed since the city began keeping official records back in the 1950s.
George?
Yes.
I'm sorry to interrupt, but Deborah's got a question for you, and this may take you back a little bit. And I'm new to moderating things like this, so sorry if I've cut you off at the exact wrong spot. But Deborah's question is, what explains the difference between OMB's and IBO's estimates for 2021?
You know, I'm not sure. We haven't really had a conversation with them on that. We didn't hear any feedback when our numbers were published. I suspect these are very difficult conditions to be forecasting. It's challenging, and I suspect it just has to do with reading the same data differently. The models that we have don't really account for these for swings of the scale we're seeing over the last 6 months. So, I guess that's not a very satisfying answer, but we've not had any concrete discussions with OMB about exactly how they got to that number. Our number is fairly consistent with we benchmark our projections against consensus forecast services from the Philly Fed and the Blue Chip. And I think we were pretty much in line. I mean, there was debate about how strong the recovery would be in the second half of the year. By the time we came out, the consensus was it was going to be less than it hoped for earlier in the year. Does that answer your question, Deborah?
It does. And before your explanation, I believed IBO's numbers more than I believe OMB's numbers. And now you've convinced me even more.
All right, I guess that's good to know.
Not that I'm a forecaster, but.
So let me just let's see. So just to give you another way of, in addition to this single quarter being by far the largest that's ever occurred, if you look back, there are 3 recessions, or now a 4th, that are captured in this data. And the first one is back here. This is the early 1990 to 1993 recession, when the city lost 350,000 jobs. But you can see there's no quarter where we even lost 100,000 jobs. And over here, we're losing over 800,000 jobs. In the 2001-2002 recession, which is somewhat sparked by 9/11, although there actually had been a slowdown starting in the city months before that. The city lost about 165,000 jobs that time. Again, there's only one quarter where it's over 100,000, and it's barely over 100,000. And then back here in 2008, 2009, 2010, the so-called Great Recession, which was certainly severe across the country, but actually the city dodged some of the effects because of the way the financial sector was bailed out by the federal government. It actually put sort of a stop on the losses for the city, and the city did lose 140,000 jobs, but it's not nearly as bad as it was in other parts of the country. So again, the three recessions, none of them come close to what we observed in the second quarter. We don't have full third quarter numbers yet, but on a seasonally adjusted basis, we can look at July and August. And there, the city has gained back about 42,000 jobs in July and 107,000 jobs in August. But we don't know what September will bring, but it's likely to still leave us short of reversing the second quarter decline. The other point I'd make just on employment or unemployment really is that the New York City unemployment rate has diverged sharply from the US. In September, it was reported at 16.3%, which is more than double the 7.9% national rate. So the recession has hit much harder here in the city than it has in the overall US economy. Just to give you a sense of some of the change in particular industries, certainly the recession has hit different industries harder and some much more lightly. These are based on seasonally adjusted monthly employment estimates, and it looks at the change from February to August. August is the latest data we have. Virtually every sector is down by this measure, but some are down much more than others. And this is just a sample of some of the sectors that have demonstrate either significantly large changes or relatively small changes. The largest percentage change is in the arts and entertainment recreation sector. They lost 64% of their jobs so far between February and August. That's 57,000 jobs in terms of level. The largest number of jobs lost was in the food and accommodation sector at 173,000. That's 46% of what they had. On the other hand, we have some sectors such as information and securities that have some of the smaller percentage declines. Information is 3.3%, securities is 5.0%, and education and health services is 8%. I would note just on the securities, in addition to the good news, the relatively good news there in terms of employment, they've now also published recent data on their pre-tax profits. This is data we watch very carefully because it has a very big impact in the revenue forecasts. And they've had their best quarter since 2009 during the recovery from the Great Recession. And they're reporting profits of about 16.8 billion just for the second quarter, which if that's sustained for the year, will certainly create a big bump in our revenue forecast when we get going on that. Okay, so with the economy contracting sharply, there have been significant reductions in tax revenue forecasts by everyone looking at the city fiscal condition. IBO's forecast, we can, just to give you a sense of how much it's changed, we can take a look at what the forecast was in January of 2020 and compare that to July of 2020 when the budget was adopted. And over it's not a full 2 years, but the parts of fiscal year 2020 and then all of fiscal year 2021, the total decline in tax revenue is 8.5 billion. This is the projection. And over the 3 years, which is part of 2020 and 2021 and all of 2022, it's 13.4 billion. These are the numbers you often hear when people say, the recession has blown an $8.5 or $9 billion hole in the city budget. This is what they're talking about. It's the decline in projected tax revenue from right before the pandemic to what we now think it will be. I would also note that OMB's adopted forecast actually had even larger reductions from January than IBO's did. And this chart actually believe it or not, shows that same information just in a more graphic form. What you've got here is the change in the forecast by individual taxes for fiscal year 2020. The blue, and unfortunately there's just one little slice of blue, is for when a tax forecast was increased. That's for the corporation taxes. The reds are all the places where we lowered our forecast between January and July. It's the largest declines are in personal income here, which presumably reflects the loss of jobs and the decline in withholding. This is general sales, which reflects the shutdown or the anticipated loss in sales tax revenue because so much economic activity was going to be restricted. If you note up here, this is the property tax, the city's largest property tax source. It's about 50%, and it's a pretty small decline. It's probably about a little over 200 million. And that's because for the property tax, the assessments and the tax rates are already set and locked in, and they don't change during the current year to reflect whatever is going on in property markets. So the only decline you see here is because of an anticipation that there would be a small increase in tax delinquencies. It's not based on the value of property going down. And then these next two slides just show it's the same setup for 2021 and 2022. I'd note that for 2021, property tax was still showing little change because there's a lag between the assessments and the tax bills. And although corporate tax had been showing a small increase in 2020, we see it now joins the projected declines in 2021 and 2022. So this was all, that's the decline in in individual tax forecasts, the changes that had to be made in the cities and IBOs and the controllers and everyone else who was analyzing the city's fiscal condition in the summer. But when you actually bring it back to just total tax revenues, the picture looks a little different. So in this chart, we're showing the projected tax revenues. These are IBO's projections for fiscal 2020 through fiscal 2024. And then we also have here, this is the 2019 actual. And so what you see is that there's not that much change when you look at total tax revenue. What's been lost is anticipated growth. So from 2019 to 2020, tax revenues are still growing, although very slightly, about 1.4%. And the reason they're growing, which may seem counterintuitive, is the timing of the pandemic, the onset of the pandemic. It comes late in the fiscal year, and the fiscal year 2020 had actually been growing fairly strongly. Our January forecast, we thought it was going to grow by 5% from 2019 to 2020. So what the pandemic has done is shave off some of that growth. It still leaves a very small positive growth in 2020. Then it declines by 3.7% in 2021, and then some more solid growth resumes after that. The thinking, just to give some context to that 3.7% decline from 2020 to 2021, if you look back at what happened in the last two recessions, in 2001 and 2002, tax revenues actually fell by 6.8%. That's taking into account changes from tax law. And then in 2008 to 2010, tax revenue fell by 10.8%. So the decline we're seeing, 3.7%, while certainly significant, is actually smaller than what the city experienced in the last two recessions. So with the decline in tax revenue, or less tax revenue than was hoped for, the city still had to balance its 2021 budget. The lower tax forecast added, 8.5 billion that the city needed to make up in other ways in order to bring the budget into balance. First thing it did was draw on funds in the Retiree Health Benefits Trust to pay current year premiums for retiree health insurance. They took a total of 2.6 billion split between 2020 and 2021. They drew down 20 budgeted reserves that had previously been allocated in the 2021 budget. That got them a little over $1 billion. Interestingly, so that they left behind a general reserve for 2021 of $100 million, which is the smallest, that's the minimum amount that they're required to have. And it's certainly unusual to take the general reserve down at the start of the fiscal year, but they do have the required amount still in there. They increased the citywide savings plan to bring about 2.8 billion. There was a little bit of federal aid that they were able to recognize immediately from change in the calculation of Medicaid payments from the federal government. That brought in 600 million. And then the budget still had a $1 billion hole, which they plan to fill with unspecified labor savings. And we've heard a lot about the discussions around this. The city has indicated that if it doesn't get the 1 billion through work rule changes or changes in health contributions and other fringe benefits, that the city would have to lay off 22,000 workers. And then there's also a request for $5 billion in borrowing authority that the state would have to grant the city, and the intention would be to use that authority over the next several years. So all of this allowed the city to show a balanced budget for 2021, despite the revenue shortfall, and assuming that they fill that $1 billion hole somehow. But therefore, I just want to make one point, that it's incorrect to speak of the city still having an $8.5 billion hole in its budget, and that's often the way it's presented and phrased, because the city has already filled that $8.5 billion hole through these various actions. So, turning to what's happened since the budget was adopted. There are some potential expense budget changes in 2021 that some could save the city money, some will cost the city money. First of all, there were debt service savings from refinancings over the summer, brought in almost 500. It is reported to be saving the city about $500 million in 2021. There has, of course, been a subsequent downgrade of city paper that may well raise future debt service costs above what's forecast in the financial plan. Although the city so far seems to have ready access to credit markets, even with the downgrade. IBO in our adopted budget analysis identified what we think is $131 million of additional variable rate debt service savings that the city would be able to take advantage of later in the fiscal year. There's also, at least for fiscal year 2021, savings from delaying the DOE retroactive payments. This just happened in the last week or so. And what that does is push about $450 million of expenses that the city had anticipated for 2021 into 2022. So it's neutral over the 2 years, but at least for 2021, there is a $450 million savings there for the city budget. There are other things where the city is likely to spend more than they budgeted. IBO expects the police department will not meet the lower overtime target that had been included in the budget. The budget reduced the city's overtime plan for the police department. We're based on the long-term experience of the city missing, the police department missing its overtime targets. We're kind of skeptical that they'll achieve that. So we put that in as a $400 million likely expense for the city over and above their plan. And then there are unanticipated costs that will arise from the school reopening, and you'll hear about more details on that from Sarita in a few minutes. Still, on net, there's probably some near-term potential savings on the expense side. Turning to tax revenues, it may seem counterintuitive that I'm going to talk first about 2020 tax revenues. And that's rather than 2021. That's because it's routine for some types of tax payments that are received during July and August of each fiscal year to be accrued back to the fiscal year that just ended in June. So that happens every year, and the city has to try to project how much it's going to get from those accruals. It's a much bigger issue this year because some of the April payments that, the payments that normally are due in April on the income taxes and some of the sales taxes, because of federal and state legislative changes in response to the pandemic, the city, those payments were pushed from April into July. And so they became, those are additional accruals the city has to account for to bring them back to 2020. And it certainly added to the forecasting challenge for OMB and for IBO. We missed it by about $750 million. Our estimate is that the collections through August are about $1 billion above what OMB had projected. And just for some context, last year the difference between the planned and the actual accrual was $130 million. Which is a more typical number. And the differences are the largest in some of the taxes that were directly affected by the delay in the payment schedule. Business income taxes, which had their final returns and then their first estimated payment delayed. Personal income tax, again, those final returns were delayed, and that pushed back the first estimated payment. The commercial rent tax is a little interesting because it's only 5%, but it's on a much smaller base. But it's an interesting tea leaf in terms of what's happening in the market. The assumption was that there would be a much faster fall off in tax payments from commercial rent tax, which is assessed on the rents that larger tenants in Manhattan, Midtown, and below 96th Street, I believe, pay. And this suggests that tenants are still paying their rent, or at least that landlords are still paying the tax. But there were positive differences on the commercial rent tax as well. And with this money coming in, even though it came in during July and August of fiscal year 2021, the city will be able to use that for 2020 to cover any expenses unanticipated 2020 expenses that emerge, and the rest will be rolled into 2021. We're not sure exactly how they're going to roll it, but likely candidates are to replenish the Retiree Health Benefits Trust, which was that was tapped to help balance the 2021 budget. They may also, some of us budget geeks are curious to see if they'll turn to using the newly approved rainy day fund or the tax stabilization reserve fund. But we'll know shortly how the city is going to move that money. They have to move it into 2021 if they want to be able to use it. So for, we had this large accrual issue for July and August of this year, but still most of the money that comes in July and August actually counts as 2021 money. We have solid information for what 2021 look like for July and August, and they're now they're showing about a $305 million surplus over what the city's adopted budget plan was through August. Those differences are in personal income tax withholding, which again suggests that at least some payrolls are holding up. Sales tax is somewhat positive. Transfer taxes on the transfer of real property are somewhat positive. The key point is that although, as expected, the year-over-year trend in tax revenue is down, collections, the actual collections are still exceeding OMB's plan. So they're down, but they're not down as much as OMB had anticipated for July and August. September, we don't have full data yet, but what we have suggests that collections appear somewhat ahead. September is the first big month in the fiscal year for quarterly income tax payments, and collections there appear in particular to have been strong. We also get a quarterly payment from the business income taxes. So overall, we're seeing for July to September, that first quarter of the fiscal year, that the tax revenues are running about 100, by our estimate, about $850 million ahead of OMB's plan. Although I stress that that's preliminary estimate. We don't have the full September picture, and of course, one quarter doesn't tell you what the rest of the year will be. But there is there potential bright news in these collections from the first quarter. The implications for 2022, the projected gap at adoption was that 2022, the city would be facing something over a $4 billion gap, slight difference between OMB's number and IBO's number. But right now, the financial plan includes $1.25 billion of reserves built into the 2022 budget. They would be able to also draw, particularly if they replenish the trust fund, $2.1 billion that could be drawn out of the retired trust fund for 2022 purposes. And combine that with the above plan collections from 2020 and 2021, it's potentially sufficient to actually balance 2022, even though it starts out with a fairly large gap. So, lest I be accused of being too optimistic, I'd like to just turn finally to thinking about some of the challenges to any optimism for the city's economy, both in the near term and in the longer term. So let's start with some near-term uncertainties. The first is the course of the pandemic itself. And really, it will determine the timing and the shape of any recovery. Question will be whether there's a second wave, which there may be some evidence already that it's beginning to grow. And the availability of a vaccine and treatments, at a sufficient level to make people comfortable going back to pre-pandemic lifestyle in terms of restaurants, going out, commuting to work. How that plays out will, will probably largely determine what the recovery for the city economy is if it recovers. So, another near-term uncertainty is the timing and the scale of any stimulus and fiscal relief from Washington. We think it's, at this point, it looks unlikely that there will be any comprehensive federal relief before January, when there's, a new Congress and perhaps a new president. And then, so the question then is, how much damage will be done to the economy while we wait for that? The unemployment, enhanced unemployment, August, some of the state unemployment expansions are running out, or in some cases have already run out. So there are permanent damage. There's permanent damage being done to the economy by not having the stimulus spending in place. The question is how bad it will be and how much damage is going to be done. Another near-term threat is comes from the state aid. The state, and specifically a proposal that's built into the state budget that says if there's a significant difference between projected tax revenues and what the state is receiving, that the state division of the budget can begin implementing unilaterally cuts to state spending, and particularly to spending for localities and school districts across the state. IBO estimates that there's a risk of about $2 billion to the Department of Education budget if the state actually went ahead with these cuts. The state so far has not pulled the trigger on this, although they have begun using what they call temporarily withholding some state aid, with seeming, by using the word temporary, that implies that they would reverse that when more revenue becomes available. Right now, that's we think that's costing the city about $100 million. It's not the $2 billion, but that's been implemented so far, and they could very well wind up having to take advantage of this budget cutting authority built into the budget, because the state was facing fiscal problems before the pandemic. They had some significant problems with the way they had been budgeting Medicaid in recent years, and the state is also much more dependent on income and sales taxes than the city, which means when a recession kicks in, their budget is hit much faster and harder than the city's. There's also a question of how many tenants, both commercial and residential, are not paying their rent. Anecdotal reports and surveys certainly suggest that this could be a big problem, although there's actually little observable evidence so far. For now, commercial tenants seem to be having greater difficulty than residential, but this may change now that the stimulus checks were not renewed, and the enhanced unemployment was not renewed, and hiring is slowing. We may also begin to see significant shortfalls on residential payments. The reason the rent, if rent isn't paid, that makes it much harder for landlords to actually pay their property tax, and so it begins to bleed into the city budget that way. And then finally, a few long-term uncertainties to consider, and one is, will the demand for office and retail space recover? In terms of office, Ronnie already mentioned, with firms getting increasingly comfortable using remote work, there may very well be a reduction in the amount of space that firms want to have in large office buildings in downtown Manhattan. Exactly how that plays out, I think, will vary a lot by industry and size of firm, but it's certainly something that could pose a threat for the long-term fiscal condition of the city. On retail, again, there's been a shift to online shopping, and that may further or that may accelerate the abandonment of street level retail space in the city, and that was a problem even before the pandemic. If the demand for commercial and property space does not recover, the value of real property in the city will decline, and the tax base will shrink, and revenues will either slow or even fall. So this is a really significant unknown for the city. More on the residential side, there's a question of, can the city continue to be attractive to current and potential residents and foreign buyers? Can the first question is, will the city be able to bring back those who have at least temporarily left, are working remotely from second homes or even further afield? There's also a question, I think, of whether the city can continue to be a magnet for young creative people, or do the suburbs regain some of the appeal that they had in the 70s and the 60s and 70s? In addition to this would lower, if there is a contraction in demand for residential space, residential property, beyond lowering real property values and then tax revenues directly, if the population falls, and it had already started to decline in the city in the last few years before the pandemic, eventually residential investment and supply would be reduced, the income tax base growth would slow, and residents would demand, there would be lower demand for things such as the arts, entertainment, and food, all things that help distinguish New York City, which would lead to the question of can the arts and entertainment and hospitality industries fully recover? There's a real question, I think, of how much leisure and business travel return to pre-pandemic levels. This is critical to the tourism business in the city, and also again to the arts and entertainment and hospitality. There are many people come to the city precisely because it has the wealth of museums, the wealth of interesting restaurants, Broadway shows. All of this would be at risk if business and leisure travel can't return or don't return to their pre-pandemic levels. One other big area of concern is the MTA. So the MTA, as we all know, has been experiencing severe financial losses. And the question is, given what they've lost in terms of funding for operations, and the burden they're putting on their operating budget for future years they've been borrowing heavily in the last few months. Will they be able to offer a level of service that's sufficient to attract commuters back to the subways as the pandemic ebbs? If they can't, I think there's a real concern about what happens. If New York City is not set up for people to drive to their jobs in Manhattan. There's not enough space. There's too much congestion. So if the subway is not a viable way of getting to work in the core, you know, that will further exacerbate the you know, the risks to the city's property base, because it would lower the value of office buildings in the center city. So I think this is an area of particular concern. And finally, I think there's a question, you know, has the pandemic and the recession, will they leave the city and the region with the ability to keep financing the infrastructure investments that it needs in order to sustain itself and to grow? So hopefully I've given you some reasons for optimism and some reasons for concern. And
Okay.
I'll leave it at that and be happy to
Thanks, George.
questions.
Yeah, we've got a few in the queue, and okay. I'm happy to read them. I have, in order, I've got Jennifer, Deborah, Fenwick, and Karim. I'm happy to read them, or if, Jennifer, if you want to, you know, state your own question or elaborate after I read, whatever works for you.
I can state it if you want. I wondered what the long-term implications. Oh no, that was Deborah's question. Sorry.
No, you're higher than anticipated tax collections and how they might impact the push for greater austerity.
As well as the conversation around state borrowing. There's been a lot written publicly about how the city should be tightening its belt more and avoiding borrowing authority. And I just wondered how the higher than anticipated tax collections impact that discussion.
The first thing I would note is, because I definitely don't want to sound Panglossian, you know, we're reporting on a quarter's worth of tax collections, and they do seem to be above plan, but there's an awful lot that can change over the course of a fiscal year. There are impacts from this particular recession that may take longer to play out in terms of when it actually begins to affect tax revenues. So, you know, these are hints that there may be additional revenue, but in no way should, you know, it would be a big mistake for people to go to the bank with these numbers at this point. You know, we're reporting them because this is what is there. But there's, you know, I think there's still a lot to be known about what the fiscal condition of the city is over the full 2021 fiscal year.
But George, wouldn't you say though that if the numbers that you're talking about became part of the public discourse around the borrowing, just to get Jennifer's question, and you show a track, uncertain track to balancing the budget in 21 and 22 without borrowing, and may I note in 22 without a major savings plan, incremental savings plan, wouldn't that make the rationale for borrowing look extremely weak?
It would certainly give opponents additional reasons to argue against it, yes.
The next question in the queue, just to try to keep things on track, but please cut me off if you'd rather just go to a more free-flowing conversation. But Deborah had a question about the long-term implications of borrowing from the Retiree Health Benefit Trust Fund. And Deborah, if you want to elaborate on that, please feel free.
I may be generalizing inappropriately from, I live in New Jersey where we have a long tradition of underfunding public pension funds, and I don't know whether we're borrowing from them or that's a different thing, but sort of my ears pricked up when George started talking about taking money out of the retiree health funds.
First of all, this has nothing to do with pensions.
Right, that I understand.
The retiree health insurance, and I'm a little loath to speak about this. there are people in this meeting that were there at the creation of this trust fund and probably know a lot more about it. I know they know a lot more, but the trust fund was created in the Bloomberg administration at a point where GASB, which is the Government Accounting Standards Board, and that determines how localities and governments in general have to report their financial condition. They put in a requirement that although the larger term is OPEB, other post-employment benefits, to distinguish them from pension liabilities.
Right.
OPEB liabilities do not have to be actuarially funded. When GASB put in its new rule, it didn't go all the way to saying you have to start funding these liabilities. You just have to start reporting on them. So in the financials now, there are lines that indicate what that OPEB liability is. The city created the Retiree Benefit Trust Fund to begin accumulating a funding source for these benefits. The city has found ways of using that money to pay the current year obligations of retiree benefits. So it has it's wound up being used in some ways like a rainy day fund. But you're limited as to how much you can take out. You can only take out the amount of your current year premium liabilities, which is about 2.1 billion currently. So it's not exactly like, it doesn't work exactly like a rainy day fund. So I guess the short answer is it's in no way equivalent to borrowing from your pension funds. If things got really bad, there's not a requirement to these are not constitutionally protected payments like liabilities are. I'm sorry, like pension liabilities are, and it's turned into more of a way the city manages its annual balancing of one budget and then rolling resources into the next budget. It's a tool that gets used for that, in addition to hopefully over time building up some funding capacity for to pay future liabilities.
Thank you.
Okay, George, we have a question from Fenwick about job gains in recent months and whether they've been in the same sectors as losses.
Right.
And also, how does payroll decline in this downturn compare with prior recessions? In other words, were there higher paying jobs lost in prior downturns? So Fenwick, if you want to chime in or restate the question, feel free.
That was basically it. I mean, the job loss is dramatic, but I'm interested in dollars swirling in the economy and what the payroll effects were. And I would guess that there were different sectors affected across those different downturns, but I'm asking.
Yes, they absolutely were. This recession has hit particularly lower income, lower wage sectors harder than higher wage sectors. In some of the previous downturns, it's been a little more, I'd say, evenly distributed. I think I'd want to firm this, but my recollection is that it was more evenly distributed. One of the things that's happened is people, even people, at IBO and I'm sure in the private sector, there are plenty of well-paid people who are able to work from home, and so we never show up in the we're not unemployed, we're not commuting, we're not going into the city, we're not eating lunch out and helping the local businesses, we're still employed. And because we can work from many of the job losses have been in places that are directly delivering services to people, such as, restaurants and hotels. And those tend to be lower income, lower wage sectors. So there's certainly this time around been a much more disproportionate concentration of the losses at the lower end, which is one reason why I think are so far
George?
but they're down on a year-over-year basis, but they're not down as much as some had anticipated, and that's because one reason is because the sectors such as the more white collar sectors have been able to maintain their employment just by shifting the location of work.
So I know we're running over time. We have 3 more questions in the queue. Karim, do you want to ask your questions?
Yeah, I'll try to be quick. One, quickly, I thought this was a great presentation, and I would just say that from the affordable side, given the comments about where the recession is hitting, we actually have not seen the significant decline in rent payments. That would be very interesting if you see something else. But I think the affordable housing sector on the rent collection side has been surprisingly resilient. Yeah, can you hear me? Oh, sorry. Okay, I was just making a quick comment that on the affordable housing side, given where you've seen some of the payrolls and employment hit, affordable housing has been resilient in terms of rent collections. So, I'm not expecting to see that change. At least it hasn't changed much, and it's been much better than we projected. I'm also not surprised by the commercial landlords paying their taxes. I mean, if you look at the way mortgages are structured, there's certainly a priority on the payment of taxes in the mortgage documents. I did have a couple of just quick questions. Just a small one. In terms of citywide savings plan, you said 2.8 billion was going to be used to cut the budget. I was just unclear how that worked, because it sounds to me like a savings would be a source of money. So maybe I'm just not understanding how that works. And then another quick question was on the permanent damage you were saying was being done to the economy. What do you think can't be fixed if we get a extensive package from the federal government in terms of the stimulus? Some of the thought process out there is that, hey, if the Democrats were to take over, New York State is probably going to get bailed out to some significant extent. What do you think won't be fixed by that type of stimulus package, if we get it?
On the citywide savings plan. Those were actions the city identified that it could take to reduce its expenses for 2021. So these are dollars that they took out of the 2021 budget as a way of saving money in order to bring the budget into balance with the lowered amount of anticipated tax revenues. So it included things like, and some of it was because of the pandemic itself. Like for example, they knew, or they had decided that they would not open a lot of the parks and some of the pools over the summer. So they identified savings there and counted that towards the citywide savings plan. There also were some anticipated debt service savings in there. It's a whole range. There's a long list of things that went into that. But the point was they're cutting their anticipated spending for 2021 by that amount. In terms of the permanent, I actually maybe permanent is too strong a word, but I think there is damage that gets done if you have families enduring 6-9 months of uncertainty about where, will they be able to pay their rent? Will they be able to buy sufficient food? That, takes a toll and also may, discourage people from being in the city. If, New York is being hit harder than other places, if staying in New York really begins to look untenable, people will leave. And that, permanent may be overstating, but that's a long-term consequence for the city. I think similarly in the, things like the entertainment and arts area, as the period where there's no work, I mean, literally no work going on. Think of Broadway. There's human capital there that you begin to lose if people just cannot stay in the city on the hope that Broadway shows are going to reopen. I mean, that has a you lose that accumulation of human capital. It's it takes a lot to bring it back and to get it committed to the city. So I mean, I take your point that permanent may be too strong a word, but I think there's certainly long-lasting consequences of going on without, if we don't get some of this relief that can avoid some of these problems.
Okay, we have two more questions in the queue. We're going to run over. I mean, at this point, I don't know if Ronnie.
Yeah. Why don't you do the questions?
We've got it.
And then I would suggest that we go into executive session.
Okay.
Very briefly, do what we need to do, come out. We can formally adjourn if people want, but for the people who want to stick around and listen to Sarita, I recommend it highly. So let's get the questions out that people have asked.
That sounds like a good plan. Okay, so Tony had a question about Tony, if you want to restate your question, feel free, but it was about the possibility of a Biden
Yeah, I mean, he has
bailout, essentially.
Well, I wouldn't quite phrase it that way, but anyway, look, I just want to know, he has a platform out that's pretty specific. Have we priced the impact of a platform on New York City at all yet? And yeah, that's all. Have we started pricing it? It won't all happen, but even if a fraction did, I suspect the impact could be substantial. So what is our read on that? Do we have a plan to actually do that?
We've not done it yet. I think that will be part of the forecasting round that we have a report we do in December, and most of that work will be done in November. And
okay.
I think we'll have the advantage, presumably, of knowing who the winner is in early November. And but either way, that will be part of what we're looking at.
Yeah, I just recommend, since the platform's out there, get a head start. Okay, thanks.
And then Wayne had a question about the how much revenue the proposals to increase taxes on the rich would generate. And as we saw, he says, as we saw the city try to do with the UFT, can the city legally change labor agreements to generate cost savings? And if so, does IBO have any additional recommendations on amending labor agreements? So that's sort of two questions. Okay. Wayne, if you want to.
In terms of the amount of money that can be raised, I mean, in some ways the answer is how much do you need to raise, because you could set rates at at levels to bring in the revenue you think you need, making provision for behavioral effects where people might decide it's too much and leave, or if there are ways of shifting income into other less taxed activities. So it's an open question as to how much money you can get, depending on what you want to do. What I would suggest, we're updating our budget options volume, and there are some pieces that were updated last January that are quite fresh. that look at a range of things you could do to raise tax revenues and how you would do it. So there, there's a list of different, if you put in a higher, it's sometimes called a millionaire's rate. If you put in the city standalone mansion tax, we created a new mansion tax for the MTA last year. But if you put one in to just generate money for the city, I think we have an option on that already. So the options volume is a good place to look for some of that stuff. And we could also, we'd be happy to talk to you about some particular ideas you might have and whether we could get you numbers on that.
Okay, great.
Okay. So thank you to everybody. I'm sorry that it's so awkward to do the questions in real time, but we're learning. So what do we need to do, Lisa, to get into an executive session now?
So I think we need to take a vote to have a board member make a motion to go into executive session.
So moved.
And who's going to second?
Second.
All in favor?
Aye.
Okay, so I would just note that advisory board members, you're going to get an invitation on your computer screen and you should accept that invitation. It will take you into a breakout room. And for everyone else that's part of non-advisory board member, we'll be back in a few minutes.
Also, just so you know, this portion, the executive session will not be recorded.
And we are currently recording.
Okay, so we've re-adjourned. Lisa and Ronnie, how would you like to handle if anyone from the public has a question? Would you like it to be typed into the chat and you can take them that way? Before we conclude, if there are any questions from the general public?
Why don't we just ask people to unmute? If they run too long, we'll find a way to deal with it, but.
I think that's good. I don't know who's here from public.
Yeah.
If anyone has any questions, announce yourself. Ask the question.
This is your big chance. Okay. No questions.
Okay.
Okay.
So I think we are going to postpone Sarita's presentation because of timing.
Sorry.
Ronnie? Sorry.
Yeah.
Thanks everyone for joining us this morning. I'm going to ask for a motion to adjourn the public meeting. I have a motion.
Moved.
And a second.
Everybody's muted, just so you know. Yeah, but that's good enough.
And all in favor, give me a thumbs up. Okay. Thanks, everybody.
Thank you.
Thank you.
Thanks, everybody.
Take
Sorry,
care.
Sarita.